Welcome back to your ultimate pit stop, Piston Pundit, where we dissect every twist in the automotive and energy world with a mechanic's eye and a pundit's perspective. In early 2025, Canada flipped the oil playbook. Once America's most loyal supplier, it made a bold swerve, redirecting its crude exports eastward to Asia. The cause? Mounting tariffs, broken pipeline promises, and a golden opportunity to align with China's surging appetite for energy. With the Trans-Mountain expansion now firing on all cylinders, Canada is repositioning itself not as a backup act to the US, but as a main stage performer on the global energy grid. Let's crack open the hood and examine the key moves that are reshaping this geopolitical oil race. Trans-Mountain's global recalibration. For decades, Canadian oil flowed predictably south to US refineries. That changed in May 2024 with the launch of the Trans-Mountain expansion, TMX, which added 590,000 barrels per day, straight from Alberta's oil sands to the Pacific coast. The majority, now headed to Asia. This isn't just logistics, it's a recalibration. China alone imported 7.3 million barrels from Vancouver in March 2025, with India and Japan not far behind. Meanwhile, China's US oil imports have crashed, down 90% since 2023. The pivot is personal. Years of American tariffs, pricing disputes, and the Keystone XL cancellation pushed Canada to chart a new path. TMX is more than a pipeline. It's a geopolitical reset. It proves proximity doesn't guarantee partnership. Canada is now sending a clear message. It won't be boxed in by its southern neighbor. TMX symbolizes independence, offering Asian markets stable supply and Ottawa a stronger bargaining position. For global energy players, Canada just became a serious contender. And for the US, this eastward shift is a wake-up call, one that could reshape the North American energy order. And speaking of shifting power, let's look at who's taking full advantage of this Canadian redirection. China's precision oil play. With US-China tensions peaking and tariffs flying, 145% from Washington, 125% from Beijing, China made a slick pivot. It turned to Canada's heavy crude, a perfect match for its advanced refineries built to handle dense, high-sulfur oil. Middle Eastern suppliers once filled that need, but rising costs and instability forced a new play. Canadian oil, by contrast, is stable, affordable, and geopolitically low maintenance. In short, a refiner's dream. Now, China's imports from Canada are soaring, on track to hit 1 million barrels per day. If that happens, Canada could become China's third largest supplier behind Russia and Saudi Arabia. This isn't just trade, it's strategy. China is diversifying away from volatile regions and deepening ties with a politically neutral partner. Canada, eager to move beyond US dependency, is all in. The result? A powerful alignment that rewires energy flows across the Pacific. As Canadian crude anchors Chinese ports, the US watches its influence slip. Energy, once a tool of American leverage, is being rerouted, and China is tightening its grip on the throttle. Before we delve deeper, do us a favor and smash that like and subscribe button. It helps Piston Pundit reach more car lovers and policy watchers like you. Now let's shift gears and steer toward our next point. US oil supply hits a pothole. Here's where things skid for the US. For years, Canadian oil made up more than 60% of American imports, feeding refineries specially tuned for heavy crude. But in 2025, that pipeline-fed comfort is crumbling. Projections suggest Canadian oil flowing into the US could drop below 3.5 million barrels a day, down nearly 1 million barrels from previous highs. That's not just a supply dip, it's a shock to the system. Domestic shale oil is too light for many refineries, and alternatives from Venezuela or the Middle East come with cost, risk, or both. The result? A nationwide price bump, with gas surging past $4 per gallon in some regions. But it's bigger than just dollars at the pump. Jobs, refinery throughput, and energy security are now on shaky ground. And let's not forget, this wasn't just a Canadian decision, it was provoked. The US sidelined Keystone XL, slapped steel and energy tariffs on Canada, and assumed loyalty came standard. Now, that loyalty's in the rear view. Washington is scrambling, mulling incentives, dialing back tariffs, even fast-tracking domestic drilling. But it might be too late. And while the US scrambles, Asia is revving up into high gear. Asia's energy trio gains traction. While China might be steering the headlines, it's not driving alone. India and Japan, two oil-hungry nations, have joined the convoy, forging closer ties with Canadian exporters. Indian refiners, built to handle the dense crude Alberta specializes in, are negotiating for up to 200,000 barrels per day. Meanwhile, Japan, wary of Middle East disruptions, is eyeing a long-term deal for 150,000 barrels daily. But this isn't just about moving barrels, it's about shifting balance. If these three Asian titans secure steady flows from Canada, they'll be forming a de facto energy bloc, one capable of rerouting billions in oil trade and potentially redefining the power map in a world still largely dominated by petrodollars and Western contracts. For Canada, it's a diplomatic jackpot. A diversified client base means more leverage at the negotiating table, pricing autonomy, and less political dependency on any single superpower. Ports like Vancouver are ramping up capacity, and oil tanker lanes across the Pacific are running hotter than ever. Yet even with momentum on its side, Canada's pivot is hitting some serious resistance at home. Resistance, risks, and the green reality check. Canada's eastward oil surge hasn't come without blowback. The Trans Mountain expansion has sparked fierce protests across British Columbia and Alberta, with Indigenous groups filing lawsuits and environmentalists staging nationwide demonstrations. The public isn't just making noise. Court orders have already stalled pipeline extensions. Critics argue the pivot is poorly timed. As global EV adoption surges, 20% of car sales in 2024, and China targeting 50% by 2030, doubling down on fossil exports feels like swimming against the current. If oil demand dips faster than expected, Canada may be stuck with stranded assets. External risks are mounting too. Rumors in Washington point to possible sanctions or regulations targeting Canadian oil firms, potentially choking off US capital and delaying future projects. Add to that Canada's tightening bond with China, which could strain historic Western alliances. Meanwhile, green tech is gaining speed. Solar prices are falling, batteries are booming, and climate policy is hardening. Canada is betting big on oil's final sprint, but if the energy transition accelerates, it may be racing toward a finish line that's already moved. Verdict: Canada's oil reboot, strategic masterstroke, or final lap? Canada's eastward oil pivot is a bold acceleration, racing to profit while the engine of fossil fuel demand still runs hot. With TMX flowing west to Asia and demand rising in China, India, and Japan, Canada is shifting from US sidekick to Pacific player. But that momentum comes at a cost. Domestic protests, legal hurdles, and growing environmental concerns are revving up. On the global stage, Washington is eyeing countermeasures, and Ottawa's closer ties with Beijing may strain long-standing Western alliances. So here's the question: is Canada reshaping the global oil game, or just postponing the inevitable shift? Will Asia's appetite outpace the green energy transition? And can Canada balance short-term profit with long-term sustainability? We'd love to hear your take. Drop your thoughts in the comments, and let's keep the conversation going. If you found this breakdown insightful, make sure to subscribe to Piston Pundit, your ultimate pit stop, for the latest on vehicles, energy, and everything in between. Thanks for watching, and keep that engine running smart. You can now check out any of the videos on the screen. There's plenty more to explore.